Good morning. This is Market Day Report. We're glad you're with us. Let's jump into the markets. Corn market. What direction are we going? Well, it's not up right now. The May contract, 439, penny and a quarter lower. Penny and a half lower on that D's contract at 463. Again, that December contract we have today and then 3 more days as we take the average of the December close each day in February, and that sets our insurance rate for corn. Now, when it comes to soybeans, we use the November contract, but soybeans overall moving higher today, 11.54 and a quarter. That's the May, up 4.5. Let's go ahead and stay in the complex here with soy meal contracts moving higher and bean oil contracts moving higher as well. We see now 3 contracts in the 60-cent territory, May, July, and August. Over to the wheat market, and we're looking at July up a couple of pennies, 5.84 and a quarter. It was hard red, though, that pulled the entire complex lower yesterday. July right now at 5.83 and a quarter, down 1 3/4. Spring wheat, and we're seeing lower trade there. Cotton market a little higher. Chris Swift's with Swift Trading. Hey, Chris, I want to jump back over on the corn side of things because one of the major buyers of corn is the feed industry.
Absolutely, and right now, I want to talk out of both sides of my mouth, Tony. We can't find much that says we're going to have any disturbances in this year's corn crop. We got a little drought, but we've had 3 years of drought in some regions, and we continue to produce a bumper crop. We may get more ethanol demand, we may not, but I'm just not seeing anything that I could project that says corn's really going to go higher. On the opposite side, I don't see much that's going to make it go lower either. We've been able to creep corn just a little bit higher. Every other day it's just a little bit higher. And so I have to think to myself, we're sitting here in a very narrow trading range. We're fixing to get into March and planting season, and down south, I already know there's rolling some tractors out there. So we better get busy and do something, whatever it is we're going to do, because I don't think the price is going to stay here very much longer, regardless of whether it's higher or lower. So when we're fixing to talk about our livestock producers out there, kind of consider what maybe a 10 to 20 cent call option might do to your bottom line. If you lose the whole option premium on it, what does that do to it? If you're $1 lower and you lost that 20 cents, you're in pretty good shape. If it's $1 higher and you didn't spend that 20 cents and you just got through paying historical highs for feeder cattle and stockers, you're going to want something out there to kind of give you some protection.
Yeah, good points of, again.
Both sides of your mouth, you know.
Buy it, sell it.
Yeah, it's whatever your really need is, because we're sitting here in the middle. And if it does go lower, you know, to the corn farmer, they're going to have something happen. I don't know what it is, but they're going to have something. To the cattle feeder, you know, again, there's not a lot of chances of it going up. But if it does, that 15, 20 cents could be some of the most least expensive protection that you could buy out there.
And at this point, something feeders really have to be focused on. Absolutely. Is that margin. Speaking of which, we'll take a break, come back, and we'll talk about cattle feeding. Next, this is Market Day Report. Let's talk proteins for a moment. We're not starting with cattle, we're starting with hogs. Hogs are hot right now and moving higher for the 6th straight session. Yeah, we've settled higher now for 5 in a row. 111.27 on the July, now 110 on the August, and pushing towards the 110 on the June contract. Right now, 109.35. That's $1.02 higher. Live cattle futures still lower on that February, which is chasing the cash trade again. The most active here is the April, which is now turned positive, 239.85 up 60, just fractional gains across the board. Feeders are higher as well. Front month up 165, 365.95, and then that 363.07 on April. It's $1.72 higher. Before the break, talking with Chris Swift, Swift Trading, talking about the feeders and that margin that they're dealing with. on the southern high plains, Lubbock Feeders announcing over the weekend they're closing after 70 years, just can't make it work. But I think we can tie some of this back over to a closed border, can we not?
Oh, absolutely. It's just the sheer number of inventory that we have to work with, and that lower amount is really, it's just like running a hotel. Everybody always says you have to have that hotel as full to capacity as possible, and the southern feed yards just don't have that capacity. When we look at those margins, I'm pretty sure that the spread between stockers and fat cattle reached their widest point last week. The week prior, we saw both the cattle feeder and the packer in negative margins. This most recent week, we saw the packer is in deeper margins, red margins, and the cattle feeder had about a $20, $30 head profit on it. As we move forward, we're still going to get into more and more expensive animals that we purchased back in the October and November timeframe. So those are now the ones starting to be slaughtered. We've also seen some really interesting aspects with the cattle on feed. The cattle on feed number showed about a 211,000 head less year over year, but 55,000 head more month over month. Long-fed cattle. So whereas we have a shortage of cattle in the south, we have a glut of cattle in the north, all long-fed. So anything, and I mean anything, that would have to encourage you to market those animals at a sooner date would flood that market with beef, because we saw last week our carcass weights were even with the week before. They should increase slightly going into the springtime. So we're going to have continued elevated beef production out there. And I see we're about 8% lower year over year, and that is sheer slaughter. It has nothing to do with the amount of cattle or beef that we have out there. It's the very slow pace of slaughter, and this has become methodical. They've got to keep doing this in order to find margin somewhere and to change the current price structure, because as the corn, the input costs are not doing anything. You can't get a cheap enough input cost for having to pay so much for that animal. So the last thing you want to have happen is all of a sudden what little bit of input costs that there is that might be benefiting you today, not into the future.
You know, I'm going to use the analogy of dominoes, though. As one domino falls, it hits another, hits another, hits another. And I think that first domino to fall is usually something called drought.
Right.
That's what pushes that domino.
Absolutely.
And by the way, Texas, 75% of the state back into drought. So no real reason to see an expansion of cattle right now.
No, not there, and nor the Mexican border, because even if they do open, and I did see the story the other day you ran about where the scientific protocols have been met to be able to bring those across. But even if you do, it's only going to be a percentage of them. It won't be whatever was what once was 100%.
Feeders close, livestock auctions close, packers close, and once that closes, that infrastructure's gone. It doesn't come back. Right. So we definitely need to keep an eye on this.
There's so much to think about with the cattle market. You can't blame it on one thing and hope that that gets fixed, because, yeah, you talk about the domino effect, all the different factors that go into it. Yeah. By
the way, Chris Swift, Swift Trading. Thanks, Chris.
Absolutely.
Great to have you here. Thank you, Chris. And Tony, of course.